Hi there. Tell me, can SOFI Technologies rebound to $20? Because as you can see, the stock price year to date is down over 18%. But maybe this business can rebound. The stock price may go to $20 or even more. As the market cap is around 7.5 billion, they might grow more in the future. Because if you look at their accounts, their members, keeps growing. SOFI has currently almost 7 million members. And that's great. Plus their Galileo accounts, which are around 147 million. And it has rebounded from the first decline in 2023, the first quarter, from 126 million to 147 million. So it's an improvement. Moreover, if you look at the analyst estimates, what the market expects, you can see that the revenue is expected to grow a lot in the future. The revenue is expected to more than double in the next 5 years. Plus, they might become profitable, as the analysts expect. By 2027, they might make over 600 million in earnings. And that will be great, because when a company becomes profitable, also the stock price will follow. And maybe SOFI will reach again $20 per share, or even more. But why the stock price is still down? Year to date is down 18%. Why that? Well, every time you look at the business, there are opportunities. As I said, this business may grow more in the future, but there is also risk. As it happened in the past, the stock price has declined by over 70% from its peak. And the most important thing for you as an investor is to buy the right time. Because if you buy the highest peak, as it happened in the past, in 2020, in 2021, when the stock price was around $22, back then, if you had invested back then, your return would have been minus 79%. And you don't want that. You want to buy when the stock price is low, as it was in December 2022. The stock price was around $4, and if you had invested during that time, your return would have been quite great, an increase of over 80%. So this is the strategy. But how do you know when the stock price is cheap and overvalued? How do you know that? Well, the answer is not that simple. Because if you want to value this business based on their earnings, you can't, even though they'll become profitable in the future. You have to look at something else. Because as you know, SOFI is a bank. It's not a normal business. And banks are valued differently. Let me show you. If you look at the price to book value ratio, you can try to value this business. When the PB ratio is below 1, as it happened in 2020, you may have a chance to increase your profits. Your return, as it happened in 2022. When the price to book value was around 0.6, the stock price was cheap in 2022. So the stock price was around $4.6. And as you can see, the return was quite great. An increase of over 70% in just 1 year. Now, to value the future of this business, you have to predict the price to book value. How much will their book value increase in the future? Well, you can try to look at analyst estimates. The market expects the price to book value to be around $5. By 2026, it may reach $6. So, even though the revenue grows a lot in the future, will double and they become profitable, you also have to focus on the book value per share. How much it will grow in the future. Because if the revenue goes up and their book value is flat, your return may not be that great. And it's hard for you to value this business based only on their future revenue. What matters is how much money they earn on their book value. So this is a good indicator for banks to follow. The book value per share. When the stock price is around this level or below, it's much better below because you have a margin of safety, you can take advantage and invest in a bank. However, when you invest in a bank that is not yet profitable, because if you look at SOFI, their past performance wasn't that great, you also have to be aware of the risk because they might not become profitable. And this book value per share might decline in the future. That's why you have to be aware of the risk, when to buy and when to sell. Because if you buy at the right time, when the price is below the book value, you may make some money. But don't forget the risk. There is always some risk. That's why it's better to look at the price to book value, the ratio, and when it's below 1 or around 1, you might be protected against the risk. But don't forget that SOFI has no profits. As you can see, the net loss has increased in the last quarter and the last 9 months. For the last quarter, they had a loss of over 200 million. And for the last 9 months, a loss over 348 million. And if you look at their expenses, you can see that their sales and marketing keep going up. So, they invest a lot in marketing to attract more customers. And that's why their members keep going up. But they are making no money. Of course, if they can attract more customers, the members to double or triple in the next 5 years, from 7 million to 14 million or 21 million, that would be great. Then they may make some profits. You can also look at their guidance. For the full year 2023, they expect the revenue to be around 2 billion. So, as the analysts expect 2 billion in revenue for 2023. And then the market expects the revenue to more than double. Now, you have to ask the question, how do they make money? And I think you already know the answer. They take deposits from their members and they lend those money at the higher interest rates. So they pay in interest on those deposits. Then they lend the money at higher rates to corporations, businesses, or other individuals. And at the end, they try to make a profit if they can. But so far, they haven't. As you can see, the total deposits were around 15 billion. This is another important indicator to follow because their members may go up, they may more than double, but if the total deposits doesn't grow more in the future, then this is a problem, a red flag, and you have to dig more. But as you can see, the total deposits have doubled in the last quarter, from 7 billion to more than 15 billion. That's quite great. As long as they attract more users, they might make more money on those deposits. But of course, you also have to ask the question about their loans. Because as they lend those deposits, there is also risk. Some of their loans may return nothing, or the rate of return will be lower. Others will be with plus. But overall, you have to look at their net losses. You can see that the net interest income was quite high in the last quarter, over 300 million. But the problem with this business, currently, is their expenses, especially their sales and marketing, technology, and others. So if they can grow more in the future to attract more customers and increase their total deposits, then they may make some money and they may become profitable as the market expects. And that will be great because NEO will rebound, the stock price will go up. But if they don't become profitable, if they don't grow more in the future, then you have this risk. The stock price may do nothing in the long term. That's why it's quite important when you invest and how you invest. It's better to have a margin of safety. That's why, as I said, the price to book value is a good indicator. If you buy below it, you might make some money. And of course, you also have to ask the question about the quality of their loans. And if they don't recover those money, that may be a problem for SOFI. Of course, as you can see, loans held for sale. They want to get rid of them to sell to other banks or other investors. They are trying to get rid of the risk. But if something bad happens with their loans, because as you know, when there is a recession, all banks go down. That's why it's quite important to focus on their risk, especially the quality of their loans and if they can become profitable. So at the current level of $7.8, SOFI may not be such a great investment. But if the stock price goes lower, let's say to $4 or less than $5, I mean less than the book value per share, then SOFI may be an opportunity if you believe in its future, that they will grow more in the future, they will attract more users, and they may become profitable. But if they don't, this is a risky investment. So it's up to you if you want to take that risk or search for better ideas. And if you have other questions, please let me know in the comments.